All right, glad everybody's here. My name is 𝘾𝙊𝙉𝙉𝙀𝙾𝙏. I'm the owner of broker 𝑃7 Mortgage. And if I can go around the Zoom and everybody else introduce themselves, we'll start with you, Susanna.
Oh, Susanna Haney, co-owner of Colorado Real Estate Group here in Colorado Springs.
And this is 𝘾𝙊𝙉𝙉𝙀𝙃, co-owner of Colorado Real Estate Group here on Colorado Springs as well.
Well, great to see you guys this morning. So yeah, this morning we wanted to talk just about some down payment assistance programs that are available for your borrowers. Most of these are, well, both of the ones I'm going to talk today are FHA related. FHA is the easiest one to do down payment assistance programs, and that's what a lot of the the big national lenders use. There are occasionally special programs that are available for conventional, like where it's a 1% or 2% down payment assistance on a 3% home ready, home possible loan. The only issue with those are very lender specific. And so a lender will offer those as a promotion for a short period of time, and then they take them back. And anything with home ready, home possible does have income limits on it. And the income limit for El Paso County is around 84,000. It's 80% of the average median income, the AMI. And so, if you're up in Denver, that's 100,000. El Paso County, it's 84,000. So a lot of times it's hard to get people to, get into that bucket if there are income limitations on it. So let's kind of jump into the FHA down payment assistance programs. So the way down payment assistance programs work, whether it's the the state ones like SHAFA or the Empowered DPA, the ones I'm going to talk about, most of them, they pay for the program in part by having a higher credit score, yield spread. So they pay for it through with a higher rate. So whereas today the FHA rate might be 6.25%, using a down payment assistance program might have like a 7.25 rate. And part of that yield spread that they get from the higher rate goes into the program. And then there's also, state funds or whatever the entity is that's funding it, they put their funds in as well. The other thing about that, this is not a program necessarily for someone that has no money in, to use for anything. It's a 3.5% or 2% down program. So, they get provided that money, but you still have money for closing costs. So unless you get a really hefty seller concession to cover that, if someone has absolutely no money.
And let's just explain real quick what seller's concession
Yeah,
is.
seller concession is where you get the seller to pay part of the closing costs. So say you're going, you're putting an offer in on a $400,000 house, and you have your down payment assistance program is covering the 3.5% down. You still are going to have $6,000 or $7,000 in closing costs. These are fixed closing costs like appraisal, title work, processing, tax transfer fees, things like that. About $3,000. And then maybe $2,000 to $4,000 for things like insurance, escrows, prepaids. These are all things that are due at closing. So you still have to be able to pay for that, even if you have a down payment assistance, which is just the down payment portion. So you got 3.5% down, and probably about 1.5% to 2% for your closing costs as well. And so if someone doesn't have any money available, then they would need they'll get the down payment assistance from the program, but they would need the seller concessions then to cover the other closing costs. So the seller concessions are, you go in on an offer, have the seller pay part of those closing costs. So say you're buying a $400,000 house. You can go in and say, hey, I'll give you the $400,000, but I would like $6,000, $7,000 of concessions from the seller. If they're reluctant to do that, if the market is in a little hotter market, you might say, hey, on this $400,000 house, I'll give you $406,000 and ask for 6,000 concessions. So the net is the same to the seller. The only problem there is, of course, it has to appraise. And so when the appraisal comes in, if there are any issues with that, if the appraisal comes in at $400,000, then either the seller has to give up that money regardless, or that the deal falls apart. So you got to play that fine line there.
And that's where we can come in as buyer's agents. We can help you figure that out, what this might look like. The concessions at this moment, what we find is that they're much higher than $6,000 or $7,000, even at a $400,000 home. I mean,
okay.
Buyers are pushing pretty hard. Karine, is that what you see as well?
Absolutely. Yeah, we definitely see that. So one of the things we can do also as a buyer's agent is also run comps to make sure it appraises like you said, Vic, and put a strategy together for that specific home. So
okay.
Yeah.
Well, that's where your expertise comes in on that, and you kind of engage the market. So right now it sounds like that is something we can do. But once again, that changes. I think with any kind of market fluctuations. The one thing that I can't do on this is I can't up the rate and get a lender credit. So a lot of times if we're just doing a straight up loan, I might get a seller concession. But if we need some extra money, I can always raise the rate and get a lender credit. On a down payment assistance program, it's a set rate. You can't do that.
Doesn't work. So, okay. What about? But you can still do a buy down if there's some extra money from extra concessions left over.
Right.
You can still buy down the rate.
Right. You can still do a buy down. That still applies, but you need to get all your closing costs covered before you go into the buy down. So you need $6,000 or $7,000 for the closing costs, and then another maybe $4,000 or so for the buy down. So if you have $11,000 in concessions, yes, you could do a 1-0 buy down. If you get more than that, you can definitely go into some of the other concessions or other buy down scenarios. Okay.
Yeah.
So let me go ahead and share my screen. I'm going to cover two things. The first one is the Empowered DPA program. This is one with a national lender where they do either a 2% or 3.5%. Obviously, the rate's going to be a little bit higher for the 3.5% than the 2%. So if someone just needs a little bit more umph, they can do that. Or if they need the full umph, then you go to the higher rate. And like I said, that's going to be about a 1% to 1.5% higher than the normal FHA rate. The second one I'm going to talk about is the Hopper program. This is one where the buyer goes in and it's a regular FHA loan, so there's no increase in rate, but it's a program to encourage solar use. And so you can, I'll kind of go into details on it, but it's just a regular FHA loan, so I can take this one anywhere as long as they're enrolled into the Hopper program. They've done all the prerequisites for it. They can get up to $13,000, 3.5% down for that one. So these are both down payment assistance programs, but they have different flavors to them. So all right, so this one is actually available through Equity Prime Mortgage, and what it is, it's an FHA program. It's a forgivable grant. It belongs to the person at closing, so it's either 2% or 3.5%, and so there's no payback, there's no second loan, there's no grant period. Like for Chafa, a lot of times you have to wait 5 years or 10 years, or there's a silent second. You don't have any restrictions like that. There's no resale restrictions. So when you go to sell this home or refinance it, you don't have to worry about this silent second that is normally lurking out there on a
That
lot
needs to be paid back.
That needs to be paid back, right? So like if you do a Chafa, the Colorado Housing Authority grant, if you sell the house in 5 years or 10 years, depending on which one you use, you have to pay that grant back. Same thing if you refinance it. You can't just refinance and do a streamline. So if rates drop a lot, you can't lower your payment by doing a refi unless you actually refi the whole thing. And so that's the nice thing about EPM. Once you're closed, that money's yours, and you can sell the house, you can refinance, you can streamline, whatever you want. And this one also, FHA has a 6% seller concession. So if you can get the 6% seller concession, that's great. We can use that for, rate buy down. We can use it for closing costs, anything like that.
And just to explain that, so a 6% seller concession, that 6% is based on the purchase price of the property that you have. So FHA then allows you up to 6% of a seller credit towards whatever you want to use.
Right. So in this example, if you were doing a $400,000 purchase, that 6% would be $24,000. So
it's quite a bit.
So that's quite a bit, and I don't know if that's usual if you've seen that before, if you've gotten 6%, but that's kind of the upper cap. But in a case like that, you're almost hard pressed to use up all that credit because you cannot use a seller credit, a seller concession for the down payment money. The down payment money has to come from bona fide sources like the borrower or a program, like we're talking about. So what you could do if you did get 6%, you could do a very hefty, like a 3-2-1 buy down, which might cost you $15,000, and then you have $8,000 left for the rest of the year, or $9,000 left for the rest of the seller concession. So there are ways to, give me the seller concessions, we'll find a way to spend it, but that's a lot of concessions. Okay.
Yeah.
Okay. So the parameters. So
just forgot one thing.
Yeah.
Wait, hold on. So what's the max purchase price? Are there only
it's the FHA loan limit, which is
currently where?
Yeah, that's the loan limit's gonna be in the mid $500,000 range, and I can actually get that to you. That changes every year for every county. I don't want to. I can look that up for you and give that to you separately, but it's in the mid fives.
So depending on where you are watching from, there, even though this is a national program, it really varies from county to county what kind of FHA purchase price limit you have.
Exactly. I'm actually looking at right now. So
because if you had an FHA limit of 550, let's say in California, that probably, in LA or so, that probably wouldn't get you much.
Yeah, exactly. Yeah. So it is the limit. So I'll have to get you the FHA one. That's different than the the county loan limit, which is like 800,000, 806,500. The FHA limit is somewhere around 5.5, and that's for the loan size. Okay. That's a great question. So let's kind of talk about parameters. So the parameters are you need to have at least a 580 credit score, and you have to have AUS approval. AUS being an automated underwriting system. That's either Fannie Mae or Freddie Mac says yes. If you present a loan with the parameters that you've given me and you submit to them, if they would approve that based on the parameters you've given, that's called an approve eligible. So 580 approve eligible. 620 would be for a manual underwrite. Those are really hard to do with FHA, but those can be done. So if you can't get that approve eligible, you can't do a manual underwrite where you have to manually go through, verify rent payments for the last 2 years, verify trade lines, and make sure that you made payments on things like your cell phone bill, your utilities, things like that. So there's a lot of verifications going to manual underwrite. Okay, and so we can use either Fannie Mae or Freddie Mac. Both of those will work. So they're program specific. So it's a regular 30-year loan. It's only for purchase. Now, on my end, it's a borrower paid comp. So generally, my comp is going to be less on these because I'm not going to charge as much just to make the deal work. Unless you get the 6%, then my normal comp is between 1.5% to 2%. So generally on these, I'm going to be charging probably around 1% just to make it work because it's got to be paid through either seller concessions or as a regular closing cost. The max DTI is 49.99. So for
debt to income ratio.
Yeah, the debt to income ratio. It's a little bit lower than than a normal FHA loan. A normal FHA loan, the top limit is 56.99. So the debt to income ratio max here is going to be 49.99 for this program. Okay, and then it's good for it's good for various types of residents. The interesting thing here is you can actually do it for a 2-unit. You could do it by a duplex, and and you can use the rents from the other side to offset your mortgage payment. It's only for a duplex though. Normally for FHA you can go up to 4-unit. You cannot do a 4-unit or 3-unit, the triplex or quadplex with this program. Okay.
And just to kind of mention real quick, the reason why it's good to use an FHA or this program, especially this program with the down payment assistance, is because if you had to go, let's say with an investment loan or with any other loans, they're just so much higher or more difficult to get. Is that correct?
That's correct. So if you try to buy the other thing is most investment loans, like if you used a debt service ratio loan or most other ones, those are for investment only. This is you have to occupy this as your
one side, yeah.
And so the nice thing about the FHA loan and VA loan as well is you can buy multifamily loans, multi-unit loan houses and use this loan that's only meant for a primary purchase to buy a duplex, okay,
Mhm.
or a triplex, quadplex if you're not using this one here. The other thing is you can use it for manufactured homes. So manufactured homes are the FHA is really good on manufactured homes. The rates are really good. The underwriting requirements are pretty straightforward, a lot better than doing a conventional loan. And so I do a lot of multi-wide, a double wide or triple wide using FHA and VA, the two loans that are really well suited for that. And it can also be in a project, so it can be a planned unit development. Any questions on the property types or the parameters?
I have heard lately that condo projects have become a little bit more difficult, especially with FHA because they have certain requirements.
Right. Yeah, the requirements for FHA and conventional to lesser extent is there are limitations on how many units can be held by one investor, how many can be rentals, as opposed to like a primary occupancy. And so you have to meet those limits, and those limits those vary depending on how much you're putting down. So the big reason people go with FHA a lot of times is because the FHA has only a 3.5% down minimum, and so it's easier to if you don't have a lot to put down, you can do the 3.5% down. Also, if you're a bit more credit challenged, it's got a lot more leeway if your credit score is not as
More
high
forgiving.
as you would like.
Yeah.
Okay.
Yeah.
Great point on that one. Okay. We can also use this program with not just the 203B, which is just a regular purchase. You can also do a 203K, which is a renovation loan, or you have something that has a repair escrow. So both of those qualify. Okay. What you can't do is you can't do a non-FHA loan with the Empower. You can't use it with any other DPA programs. You can't mix and match. I mean, it would make sense. And you can't do a high balance FHA, which would require a greater down payment. Okay?
Okay.
So there are eligibility requirements for this. It's pretty easy to get someone to fit into one of these different programs. So yeah, I'll kind of run through these really quick. This isn't really that important, but these are the four categories that you run into. So a first-time home buyer, obviously, if someone doesn't own any other houses, they can use this. And this is better than like the Fannie Mae and Freddie Mac program because there's no income limit on that. So if you're a first-time home buyer, you're eligible. Okay. If you're a current retired employment or you have some volunteer group, if you're a fireman, military, physician, anybody that's into a first responder category can go into this military, educator, medical personnel. Like I said, you can kind of squeeze this to fit, a lot of people into. Excuse me. I was going to go over this. Obviously, you have to be purchasing the subject property, and you can have had an ownership in another place, but within the last 3 years, but you can't have it at the current time. Okay. Yeah, we talked about this right here. Now there are ones that have income limitations. So if someone is below the $84,000 limit that we talked about before, they would qualify. And So first-time home buyer, first responder, military, income limitation, and that's it. So most FHA buyers are going to fit into that one of those buckets. So I've not actually met anybody that couldn't fit in a bucket on those. Okay.
Quick question, Vic. On the 84,000, is it for either one person on the loan or couples, right?
It's the total qualifying income. And by the way, that I want to make a correction on that. That's for the Fannie Freddie program. For this one here, it's actually much higher than that. It's actually over the AMI. I think it's 140% of the AMI. So I apologize if I kind of mix my apples and oranges. It's going to be somewhere around 140,000 for El Paso County.
Okay.
So that's a pretty good limit. I mean, most things will fit into that. Some of the other requirements, you have to do an education class. So you do have to, any DPA program, you have to do home counseling. And so you either do one of the home counseling programs that are um, uh, like the Fannie or Freddie ones, or the programs that they offer online. They're called the framework class. The framework is the same one that you do for the Fannie Mae. You can use the CFPP. There are a lot of different programs that you can use to get that. Basically, you go through, you do the class. It's about an hour or two. It teaches you a lot of really good stuff. And when you're done with that, you get your certificate. You send me the certificate, and you're qualified.
And the CFPB is still up? or
There's
has
they're yeah, I mean they're still there. It's just
okay.
I mean there's a lot of political stuff going on with CBB right now as far as I mean they were established by an act of Congress, so I mean they're not going to go anywhere. It's just a matter of whether they're going to be limited in what they can enforce. CFPB is a Consumer Finance Protection Bureau, and they're the ones that kind of specify what goes on a loan estimate, on a closing disclosure, and they're there to protect the consumer. Okay, they're one of the federal regulators. Okay, so couple questions, that come up. I mean, there are a bunch of uh, facts here, but yeah, you can have a non-occupant co-borrower. So if you have someone that's going to help you out, like if you have a parent that's not going to live there, but you need to use their income, you can have that as a program. Um, uh, if you have a husband and wife, do they both have to meet the requirements? No, just one of them has to meet the requirements, for being a first-time home buyer, being an emergency responder, something like that. The two of them together, though, do have to be underneath the income limits. We can't do TBDs, and like I said, the funds are available at closing.
What are the TBDs?
To be determined, so
Okay.
you can't qualify someone on a to be determined house. So I have to have a property address. I have to have a contract to get the AUS approval to be able to do this. So I can't send you someone and say, hey, this person's approved no matter which house they're going to. They put an offer in that this program is good. I need to actually put it in for a specific property.
Okay. Very
Okay.
cool.
All right. Couple other minor things. Yes. Only one borrower has to do the counseling, and uh, you can add more to the down payment if you want to. Generally, if you can't add too much more, it doesn't make a lot of sense to take the higher rate if you have money available. But yes, you can add money for the down payment to make it more. And then there are a few extra disclosures that come out in the package when we do the program. Okay, that's it for the Empowered DPA program. Do y'all have any questions on that one?
No, I think
That's a very
Okay.
interesting program. I mean, I think it doesn't have too many. I mean, a lot of people could qualify for this, right?
Yeah, like I said, I've not actually met anybody that couldn't qualify for the DPA program. I mean, the aperture is so wide that most people will qualify for that. If they don't qualify based on being a first-time home buyer, then they'll qualify based on being a very broad category of first responders, including military and firefighters and teachers. Um, and then the AMI, the income limitation is pretty high at about 140. And so yeah, it's pretty easy to get people to qualify for this one.
And you said if I remember correctly, there were no restrictions or requirements in regards to the length of time that the borrower is holding the house,
Right.
right?
There's no restriction on that.
Okay, because we actually see quite a few people selling after having owned the property only a very short time. So
Right. I mean, the problem there is not necessarily the Empowered DPA program. It's going to be with the just
the
recouping
value.
the value of the house. And so the issue isn't necessarily with the loan program. It's with just general real estate stuff. Okay.
Yep. Yep.
But those are great questions. So let me go straight into the Hopper program. I'm not going to take too much time with this one, but this one is a little more specific. So this one here, the Hopper program is to encourage folks to kind of get renewable and to put to get solar on the house. So most people that are using FHA loans, the last thing you're just trying to get into the house, much less get in something that it has the advantage of having solar. And so this program was made through the Attainable Housing Advocates to fund solar installations on purchase. Now, what's interesting about this program is um, that it rolls the cost of the solar into the house. So say you have you're looking at a $400,000 house, you're looking at a $30,000, $30,000 solar installation. Even though the contract's going to be for 400,000, your loan's going to be based on a $430,000 install minus your down payment. And so it would be, the loan is going to be more than where it normally would be for just the solar, but you're getting a down payment assistance and you're getting a solar installation, which is going to help you with your power bill and their tax credits that they're experts at this. So let's kind of run through that real quick. So it's up to $13,000. So if you're thinking about a 3.5% down, that's going to be something a little shy. You're gonna get about $350,000. You'll get the full down payment. Anything above that, you would have to bring some money to the table yourself. Okay. Um, how does this one work? Oop. Why won't it advance? Come on, let's advance.
Ah, there you go.
When I close that one out, just go to this one here. There you go. So the Hopper or the Hope 4, this is a little more education required on this one here. So there's like a 6 to 8 hour online course where they do the same thing, first time home buyer classes, everything like that. But they also kind of go over the program itself. So this one starts. I can use this with any lender. I could take this to EPM. I could take it to PRMG. Take it to UBM. The lender doesn't matter. They're qualified, through the Hopper program. And so I would go ahead and do a pre-approval, and it's going to be at a regular rate. So instead of being like a 7.5% rate for the EPM program we talked about before, it'd just be a regular, rate, whatever the prevailing rate is today. So you get pre-approved, then you complete the online course, the 6 to 8 hours, and then you get your certification, and then you're good to go. So then you go out and you shop the house and everything. When you find the house, we take a look at the solar installation, and you get a quote for the solar installation, and then you do a loan for the entire amount, and you get that 3.5% down up to $13,000 at closing, and then they also assist you. Part of that 6 to 8 hour program is to help you on the taxes on recouping a lot of that, because there are huge tax benefits to installing solar. So this is available in Colorado, which is the only place I operate, but it is available nationwide in about 30 different states. Obviously, it's an FHA loan, so only a primary. And if the house already has solar panels, it's not eligible. So obviously, that would make sense, because this whole thing is geared toward having people to encourage people to put solar on their house for environmental reasons. And yeah, there's no income restrictions on this one here. So even if someone's making more than 140,000, that would make them eligible for the DPA program that we talked about previously. They can still use it on this one. And then it can be first time, or there's no first time home buyer requirement. So here's an example here. So if you look on the two columns here, you have like a stand. Let's go back. There you go. So this is a standard FHA right here, and the Hopper compared to the Hopper program. So say on a $500,000 house, you have a $40,000 install, little high, but so the mortgage payment is going to be based on the actual cost of the house plus the system. So the mortgage payment would be $2,893 on in the one example, but it's going to go up by about $200 to 3,108, because you have that extra $40,000 that you're financing. Taxes, insurance, PMI, or tax insurance can be the same. PMI is a little bit more. But here's the deal: on your electric bill monthly, you're not going to have much in the way of electric, because you got these solar panels. And so even though you're paying more for the mortgage, you're paying a lot less for your electricity. And then your cash to close is going to be a lot less, because you got that $13,000 grant. And so you have much less to bring at closing. And then when you do your taxes, and that's part of the education program, you're going to get that tax credit for, in this example here, $12,000. And so that recoups. And so it makes the whole thing, much better. And you have a much more environmentally friendly house at the end of the day, and it keeps paying you dividends year after year. Once again, this one here, if rates drop and you want to do a reduction in your interest rate, do a streamlined loan, you can do that. There's no restriction on how long you have to keep it, or there's no lien against the house for the Hopper program. That's your cash at closing. Okay.
All right.
So
So the solar panel.
interesting.
Sorry, just one question. So the solar panels would be installed after closing,
Right.
correct?
Uh-huh.
Yeah. So you get the buyer would the borrower would get the money to spend that. It's put aside for the solar panel.
Exactly. It's escrowed, and then the solar installation happens after closing.
Mhm.
And are there certain contractors that have to be approved or certain companies? Let's put
Well,
it this way.
it's yeah, it is a solar company that Hopper contracts with, so they would be doing that. So
Oh,
it's not
okay.
just any solar company, although they do have they have to be approved with Hopper, so it's not they don't have like it's not their specific company, but they have a list of companies that they work with to do the solar installations, depending
Okay.
on the state.
All right.
Okay. Interesting thing about this 13,000 though, you can actually use this like a VA loan. You can use that 13,000 for debt payoff if you want. So
Really?
yeah. So it doesn't have to go toward the closing costs or the down payment. You can use it however you want. It gives you a lot more flexibility on how you mix and match that. So this is the only time I've seen an FHA loan where you can actually use the funds for something besides the down payment or the closing costs.
Now, with the Hopper, I guess Hopper
Yeah.
program, if the buyer were to get additional concessions from the seller,
Uh-huh.
they still wouldn't be allowed to use any of those funds towards
That,
credit,
right.
towards debt reduction, right?
Right. So if you say you got a seller concession that covered all of their closing costs plus something extra, you could actually use the seller concessions to play the closing costs, and use part of the hopper to as your down payment and part of the hopper to pay off debts. So yeah,
Hmm.
if you need that to
Okay.
qualify.
Okay.
Okay.
Yeah. And
Um,
by the way, just wanted and the reason I'm asking, just to
mhm.
kind of make that clear for anybody watching, is that, if you have credit card debt at, I don't know, 19 or whatever percent,
Right.
that would be so much more beneficial if you're having a mortgage at what, 6, 7%,
Uh-huh.
and you can roll some of and pay some of that off, some of the
Right.
credit debt that you have. So that's why I'm mentioning it.
Yeah, it's a huge benefit if you can do that. Like I said, this is the only one that I know of that actually allows that at closing for debt payoff on an FHA loan. VA that's been around for years, but yeah, FHA this is the only one I know of like that. Okay, and that's kind of it for the for this one here. We kind of went over everything. I'll kind of review real quickly. Just got to do the self-paced education program. The install is after closing. There is a post-closing financial mentorship program that they ask you to do, and then they also ask you to be available to do any kind of surveys. And they are interested in how people, what the success is afterwards. So they do look at the people, and they actually do reports on this on how the homeowners are doing with the solar, and that they're keeping up on stuff, that they're not going into default, things like that. So just a really, really good program if you qualify. So big thing here though, and what I love about this one is it's a normal FHA rate. So it's today's FHA rates. It's not a higher rate. And then that's a problem a lot of times you get into is someone that qualifies FHA, if you are limited income wise, when you go to that higher rate, that really reduces your purchasing power, and so you don't have that with the Hopper program.
Okay. Very
All
cool.
right. Well, ladies, that's kind of it for the two programs I wanted to talk to you about today. I mean, there are a lot of down payment programs out there, but these two are so contrasting. The EPM one is kind of the standard one, that Empower program, with the higher rate, but the funds are available, paid for pretty much by the higher rate. This one here, the loan is going to be a little higher, but the rate's going to be a normal FHA rate, and you can buy it down. You can do buy downs with it as well if you have the concessions for it.
And they have the same income restrictions and credit score requirements like with the previous program
No, this
on
one doesn't
Hopper.
have. That kind of wraps it up for the down payment assistance programs that I provide. Like I said, there are a bunch of them out there. Those are the two that I find are very useful. And we kind of discussed the pros and cons of each one of those. I dropped two links into the chat. One is the Colorado loan limits for FHA. So that is $4,600 for a single family, and it goes up to over $1 million for a family for a fourplex.
And we'll have that in the description below. Just
okay, great,
we post
fantastic.
those
Yeah,
links
and you
there.
can put that link there, and also just do that one for El Paso, because I think most of us work mostly in El Paso. You probably might work up in Tulare, maybe Douglas, occasionally. Anyway, hey, I wouldn't want to take a minute and say thank you, Corinne and Susanna, for taking your time and kind of looking over this program. And if you have any final thoughts or anything else, Susanna.
Well, thank you for explaining this. I mean, it definitely pays to shop around, have a lender who knows and gets educated, and that there is a connection or, good cooperation between lenders
Mm-hmm.
and their agents. I mean, we're all a team working together.
Mm-hmm.
So, yeah, thanks. Um, where can people find you if they want to learn more about this?
Okay, my best way to get in contact with me is my phone. I answer my phone when people call, 719-304-4900. And then I'm also at Peak 7 Mortgage. If you Google Peak 7 Mortgage, I have a webpage on Google Business as well. So I'm pretty easy to find by either one of those methods. My email, by the way, is vic@vicmalone.com. I'll
We'll blend it in.
drop that in here, vic@vicmalone.com. So those are the best ways to get in touch with me.
Great. Kareen, what about you?
Yeah, just want to thank everybody for watching. And if there's any questions, of course, don't hesitate to reach out. We're here to help. It's quite a process. And like Susanna was saying, it's a teamwork. So it's very important to get the right people around you for this very important purchase and decision. So we're here to help.
All right. Awesome. Well, thank you so much. And hopefully see you soon at the next closing.
Absolutely. Talk to you later. Bye-bye.
Bye. All right. Stop the recording.
I guess I